Another look at the major downside reversal we saw today on the street. The Nasdaq up nearly 1.5% at the highs, then closed down more than 0.5%. The S&P and the Dow did follow suit. Meantime, 10-year Treasury continues its unrelenting climb, closing over 4.2 for the first time since '08. An even bigger record set by the yen, the weakest against the dollar since 1990. Meanwhile, take a look at shares of Tenet Healthcare, down over 15% tonight. Outlook was below expectations, and they did announce a buyback program. God, that seems to be the trend. Some bad news, buyback.
Yeah, $1 billion buyback. For now, it's probably a $6 billion company. It's not insignificant. That's the good news. The bad news is, I mean, this fourth quarter guide is a joke. I mean, they guided $1 to $1.54. You could drive one of those JBHT trucks through that, number one, and that's coming off, I think, consensus of $1.80. None of this is particularly good. So the stock is probably trading 46 or so. I'm looking at it now. Makes sense. It actually should be lower. This is a name that I've liked in the past, and I probably still like, but this guidance is a disaster. I'd really like to see what they had to say. With that said, they're still probably the best hospital out there, but the guidance, somebody has to do some explaining here.
On the flip side, Elevance, which used to be the old WellPoint, had good numbers today, lower medical loss ratio, so maybe that's dollars that would have gone to Tenet that didn't. But Guy, other than today, is very, very, very spot on for a long, long time with Tenet.
You know, to your point about, like, it seems to be the playbook, buy back the stock if you're gapping lower in 52-week lows. I mean, this company, this is a joke. I mean, they have like a $5 billion, equity market cap and like $15 billion in debt. You know what I'm saying? So, like, it just seems like.
Well, a program doesn't mean they buy it back either.
Right.
I mean, they just can make an announcement like that, and it's a great headline, but it does not mean they're going to go buy that stock. So Snap did the same thing tonight. They talked about a $500 million program, big deal.
Yeah. Speaking of which, your earnings, another look at Snap tonight. The social media giant tumbling to its lowest level since March of 2020. Advertisers are fleeing. Jefferies senior tech analyst Brent Thill joins us for another look. Brent, what stood out to you in terms of the metrics, the guidance, even after, 6 weeks ago, telling us that August was accelerating?
What stands out is they don't have a clue on visibility. They're basically saying revenue growth is accelerating what they see now, but they're saying it's going to drop off a cliff in the back of Q4, taking revenue growth to zero. Again, this is a company a year ago said they can grow 50% indefinitely, and everyone was like, they jumped the shark. There's no way they're going to make that number. But to get to zero just shows you they just don't have any visibility, and brand advertisers are pulling back. This is a sign of the macro economy. We've said this before, advertising is the first thing a CEO cuts at a company when we go into a macro pullback. And so ultimately, we don't think Google and Amazon and the rest of the advertising ecosystem is going to be as bad as Snap, but we're seeing this. We even saw it in results of Adobe. They have exposure to advertising markets. These markets are softening, and it's a direct reflection of the macro coming down and the tactical pain we're all seeing across the broader macro landscape. So,
hey, Brent,
part Snap specific, part of this is also advertising, and clearly I don't believe Google will be as bad, but I think everyone is bracing now for the worst.
So I think you've addressed some of the main questions in there. So I'll just get into then, the companies that have been already marked down multiple times that I agree are not Snap. Where are valuations sensible, even in an environment where we know the ad spend is coming in?
I think the valuation sensible still at Google at 9.5 times EBITDA. It's one multiple turn below that of S&P. So Google has really good support. Clearly, I don't think anyone in advertising right now has support. We're seeing multiples in the internet basically fall out of the sky. There have been names like Lyft that go in Uber go to 1.5 times sales across the industry. So I think what we're seeing is even though Snap looked cheap going into this, the multiples really don't matter. As long as the fundamentals are deteriorating, no one wants to be in tech. And what I'd say is that our clients continue to be overweight energy and other sectors, and tech has really given them no reason to come back in. So our clients are telling me, hey, thanks for talking to me about software and internet, but I'll talk to you in 2023. So it's an awful tone. Everyone's underweight the group. I think right now everyone's just waiting for all these companies to reset numbers. And we've said this, there's going to be a lot of black ice this winter. Again, in Q1 23, until these companies really cut the numbers hard. And we're starting to see almost every single tech company cut numbers. That's probably not going to come to a head until early 23. And so that's why we're still, tactically concerned about multiple compression. But for long-term investors, I mean, I heard this show earlier when Dan was talking about below 10 on Snap. I don't disagree. I mean, how could Twitter be worth 44 billion and this is worth 13, 14? They're growing users. The revenue was okay. The EBITDA beat. The numbers in the quarter were okay. It's just the guide was awful.
As for Snap itself, we've spent the year going through earnings report after earnings report all year long where we get 25 down after the market. Do you think there's a comms issue that's worse at Snap than at just about any peer?
Yeah, I mean, they're going through some turmoil, right? They lost two of their top ad execs to go to Netflix. So you have effectively that happening. You have, I think, the advertisers are saying they want to go where the wallets are. So my kids love Snap. They're on Snap. They use it more than they did a year ago. But advertisers aren't there because the younger audience doesn't have the capital. The parents have the capital. And if we go into a recession, right, we're still going to buy shampoo and toilet paper and other things off of Amazon. So you're going to see advertisers flock to Google, Amazon, these proven platforms. We're hearing it through these ad checks. They're still spending. They're going to Trade Desk for connected TV, and they're benefiting in a big way. So there's others that are benefiting from Snap's failure. And obviously there's a TikTok issue that's going on as well here. So I think it's competitive. It's dollars in advertising moving to proven spend. And then you have just an overall macro slowdown, which again, the first thing, it's a stereo knob. It can go from 10 to 1 or 0 overnight. CEO can walk in and say, no more ad spend. And there's nothing like that in enterprise software. They don't do that to Salesforce.com budgets, right, or Microsoft budgets. So this is the first place you can cut. I think it is an indication of where the macro is going for the broader market. And again, there's little visibility that we can see right now. And again, when Snap starts the quarter at 9% growth and says it's gonna fall off and they're gonna end up 0 for the quarter, that sums it up right there. It's zero visibility.
Right. Brent, appreciate that. Brent Thill joining us on Snap tonight. Let's trade it. What do you think in light of all that?
Well, I think for the investors that watch the show, a lot of them aren't day trading. A lot of them are actually long-term investors. And everything he said about Google and even Facebook, but I'll just stick with Google, is why you should be nibbling in stocks like this. And again, we're talking about a company with a PEG ratio of probably less than 1. And even, throw some in recession out there, throw ad budgets being cut. I just think these are the times that these types of companies go on sale. And Google's business doesn't get destroyed here. In fact, if anything, as Brent talked about, on a relative basis, they are the place that people will go to.
You think it's as simple as just instant knife to ad budgets? Because P&G was on earlier in the week, and they're like maintaining some budgets because they believe their pricing is going to hold.
Yeah, I guess we can believe Snap. They're saying, yes, that is what's happening. We'll see if Meta confirms that. I think directionally it's happening. Maybe Snap is trying to sort of, massage it a little bit to look better. But, Alphabet is my biggest position, so this is painful for me as well. But I just feel like the valuation, I know he said it's black ice, which is an interesting term. That makes
scary stuff, by the way, black ice.
Black ice.
Man, I lived in Russia, and there was a lot of black ice there.
So that's scary,
weird.
But, I'm long, I'm staying long. I don't think I'll be able to sell it and then be able to buy it back and figure out when. I'm just staying long. I like the name.
I mean, we have like a history lesson here. By the way, David Lee Roth in a landslide on the poll, number 1.
Anyway, back to Van Hayden.
I'll go to Google real quick. I mean, I think all roads lead back to Google, which is a stock, you can say it, on valuation, you can make an extraordinarily compelling case into earnings next week. And Facebook, Meta, their problems, most of them are self-inflicted. 126 now. We're within a whisper of their 52-week low, which is remarkable if you think about where the stock, where it is now. And even with the valuation, it's compelling how poorly it's traded.